Hello and welcome to The Money Movement. Today we're going to be talking about car finance, specifically one type of car finance known as PCP, which stands for Personal Contract Purchase. So how does it work? It's getting a loan to buy the car outright, which you can't afford or don't want to pay it outright now, and you pay the finance company that lends you that money back over time. So the way they structure these deals, and this is all done within the dealership, they just give you the final product, is you pay a deposit. That's how much you put down, you pay via card or cash in the dealership, and that's how much you put towards the car. Then you do set monthly payments over a certain period of time towards that PCP, gradually paying off the car from the person you borrowed the money from to buy it. Then at the end, you have what's slightly different in the PCP. It's called an optional final payment, or a residual value, or a balloon payment. And what that is what they estimate the car to be worth after you've finished your deal with all the parameters you've set. So you go into the dealership and you say, that £20,000 car there, I want to buy it via PCP. And they go, fine, how much do you drive? How much mileage do you put on the car? And how long do you want it for? And you say, I want to have it for 4 years and I want to do 10,000 miles a year. So they say, absolutely you can. Then they look at how much they think it's going to be worth at the end of your deal. So they look at the amount of mileage you're going to put on it. So it's going to be a 4-year-old car with 40,000 miles on the clock. How much is that worth? And let's say that's worth £10,000. So what you have is you have a car that's worth 10,000 at the end, 20,000 now. Then you pay off a little bit for your deposit, and that gap there between the residual value and the total value of the car when you buy it is what you pay in those monthly payments. So it's just split up and chopped into monthly payments for you, plus interest, because of course you're borrowing the money. So interest, remember, is how much you have to pay on top of what you borrow when you borrow money. So it's additional to what you actually borrow to buy the car. So that residual value is really important because it's what creates the monthly payments. You find often that actually newer cars, higher spec cars, more expensive cars that are cash terms more expensive, finance better. They're actually cheaper than second-hand or lower spec cars. And that's because the residual value is higher, so the amount you have to pay over a monthly basis is lower. So just remember that when you go to buy a new car, is that if you look at two PCP deals for a new car or a highly spec car and a lower spec car, or a used car and a new car, they will be different. And occasionally the newer, more expensive one will be cheaper on finance. And that's all because of the residual value. Okay, so there's one more thing to remember. Deposit, monthly payments, final optional payment. You don't have to pay this one over here. What you can do is two other options. You can either pay it, in which case you'd own the car outright. You could sell it any time, there's no more payments. It's your car to do as you wish. The second is you don't pay it and you simply give them back the car, your payments stop, that's it, end of the contract. Or you can go to the dealership and say, I've got this car on PCP, I want a new one. And they'll do some arrangement where they take the value of that car and add it to what you're going to borrow for a new car and change your payment slightly, depending on how much the car's worth compared to how much you still owe, how much you've paid off in those monthly payments. Negatives, there's three main ones. The first one, interest. That's what you pay on top of what you borrowed to buy the car. So for every pound you borrow, most likely you're going to be paying back sort of £1.10 because of the interest. Check the interest rate. Often newer cars have lower interest rates because of the higher residual value. Just remember that. Second, credit commitment. Goes in your credit file, shows as a loan. It will affect the amount when you go to get a mortgage. I say it again, it will really impact you when you go to get a mortgage because you will be able to borrow less because of your credit commitment. So if you're thinking, should I get a car on finance now or should I wait 6 months? If you're buying a house or a flat in between that time, do it afterwards. You've got more chance to know how much your budget's going to be and it won't impact how much they'll lend you. Third one is that because it is a credit commitment, if you don't pay it, it goes on a default on your credit file, which can really impact you in the future. It can make it really difficult to get credit cards, loans, mortgages. So just remember that. Three negatives: interest, to credit commitment, so it shows up for mortgages and you'll be able to borrow less. And if you don't pay it, it will really impact your future finances. So as always, that's a quick run through. Any questions you've got, do drop us a comment, follow us on our social media channels and reach out and we'll be really happy to help. But until next time, you take care. Hey guys, one more thing before you go. We just wanted to say this is the first time we've filmed since the coronavirus outbreak. So we've been on lockdown, we've been keeping everyone safe and doing as we should. We've been doing a little bit of content on TikTok and Instagram, so go follow them because they've got tons of content from the last couple of months. But we just want to say that we hope that you, your family, everyone you care about is safe and well. Keep safe out there, and it's a really difficult time financially. So if you, friend, family's got any financial issues, you want a little bit of guidance on, you want some help, you want to understand something, just get in contact with us, drop us a DM on Instagram and we'll be really, really happy to help.